OPEC Plus has apparently agreed to go through with a larger than expected oil supply hike in May, and that's weighing on oil prices. Let's get more from Eric Nuttall, partner and senior portfolio manager at Ninepoint Partners. Eric, great to see you.
Good to be here.
I guess some people might say you'll be lucky if you get away with that OPEC Plus with the drop in oil today.
Yes. It was a surprising press release to wake up to. And unfortunately for them, I think they could justify it through looking at strong enough fundamentals, at least before yesterday, looking at inventories being low, the market that you're losing U.S. shale production, it's no longer growing effectively. So fundamentally, I can make the case. I would just say, though, optically, it's horrendous timing, like the day after Liberation Day, and I think it supports this false narrative that the White House has a lot of influence over Saudi Arabia, over OPEC members. I've been working the phones all morning. The best sources that I have available suggest that that is not the case. So this is a scenario where OPEC sees stronger demand. Now, obviously, we can challenge that with what happened yesterday. With you've got economists cutting U.S. GDP expectations by 1% to 2%. So there's likely going to be a hit to demand growth this year. I think that's very reasonable. And so, as bullish as I am on energy stocks, from oil perspective, this is not a bullish day.
Let's get to a good news story here, though. It looks as though the major Canadian oil exporters will not be hit with a 10% tariff.
That's right.
Because their production apparently adheres to CUSMA, the trade deal that succeeded NAFTA. And Greg Pardy of RBC, for example, says he's been talking to a whole bunch of oil companies, including Cenovus, Imperial, C&Q, just about all the biggies, and they've confirmed their production is compliant with the trade deal. Yeah,
we had long argued that oil energy from Canada would be fully exempt. Like it'd be massively inflationary, especially with you've got PADD 2 refineries, so the Chicago area importing in 3 million barrels per day of Canadian heavy via pipelines. We've said this for 3 months. It feels like until we've been blue in the face, and so we're vindicated from that. At least it would have been epic stupidity to tariff a product which is as critically essential, is the most visible cost of living, and for which you have no substitution. And so we look at differentials today. We're still in the seasonally weakest period of demand, at least for Canadian heavy. And differentials today are actually below $10. So I think that's a 4-year low in terms of the discount. So I look at it today. I still think 70 is a good price to be using average this year. We've got net speculative length has ticked up a little, so I think you're seeing a washout today from that. So you've got demand worries, you've got confusion about the OPEC Plus plan going forward. Will they defend the price? All of these different narrative stuff to battle. But I look at it and you've got a 70-cent dollar, so you're still getting a massive foreign exchange premium. You've got very tight differentials, oils, around $70. And you're seeing companies using that free cash flow and buying back their shares. Like one of our holdings, Athabasca, bought back 2% of their shares outstanding just in the month of March. And this was oil slightly below 70. And so, yes, days like this are very uncomfortable. I'm not suggesting people go out and deploy all of their cash if they're sitting on any. It's better to wait to let things settle out. But there are opportunities. There's opportunities in companies that are doing just fine at the current oil price. Half of our fund now is in natural gas. We're very bullish in natural gas now and going forward, especially in Canada, as LNG should be starting to ramp up the next couple of months. So there's opportunities. But, today's development with tariffs for sure, negative oil.
Slowing the global economy.
Yeah, I feel like that's very reasonable. Yeah. So, and we're all guessing in terms of what the quantum is going to be. And so that's going to be a lingering uncertainty that the market has to deal with. So you want to be pragmatic. I get cast with the perma bull, but we're bullish on energy stocks because we know just how strong these business models are. We know how strong the balance sheets are. We know how strong the inventory depth. We believe that U.S. shale companies are going to be forced to come to Canada over the next year to replace their depleted inventory. We're blessed with all of these resources. We have an election in a few weeks' time. We'll see what happens. My own hope is we get a government that embraces this sector, kills C-69, which prevents any new energy project from ever being again.
Well, I mean, the Liberals would deny that.
Sure they will, and let them deny that. Yeah. So my hope is we have change coming in the next couple of weeks as well. So there's a lot to be encouraged with. Days like today are obviously uncomfortable.
What is your favorite big cap Canadian energy stock right now, Eric?
I'm hesitant to say it.
Okay.
Because if I say it, I'm restricted for 3 days. So I would say C&Q right now. It'd be Canadian Natural Resources.
Let's put a chart up for that.
So this is a stock that you could buy today. We own it in the fund. We're 9.5% weight. So I'm saying it because we're unlikely to be able to add to it because 10% is a max weight for us. This is a sleep at night kind of name where you get enormous resource depth. Out of all of the biggest global super majors on the planet, they have some of the deepest reserves. And it's in oil sands, meaning the quality of that doesn't erode over time.
Sure.
We've seen the biggest shale companies warn of inventory challenges, and we see the rate of growth slowing, and we see the wells that they're drilling getting worse and worse over time. You don't get that with CNQ. You get a commitment to return now, let's call it 60-ish% of free cash flow, but ultimately that's going to go back to 100%. And you've got a company that's showing discipline on natural gas. They've pledged zero organic production growth in natural gas this year, so they're doing their part to help out the basis differential. You get a management team under the leadership of Murray Edwards, he's a workaholic. He's got his eye on every level, literally every level of detail in that company. We would have them trading at $70 oil, roughly 5.5 times cash flow, about an 11%, 10.5 to 11% free cash flow yield. So for a large cap, you compare it against their global peers, it's trading at a discount. It's been very heavily sold heading into concerns about a tariff because they don't have the buffer of refining, especially U.S. refining to offset that.
But you say the tariffs are a non-event, a red
non-event.
herring. Yeah.
So this should have been a good day for Canada, for at least for Canadian energy stocks, because we've seen it on the trading flow. Like there's been massive both shorting and selling of names like Athabasca, MEG, CNQ, those companies most exposed to a tariff. We've done our best to communicate why we didn't think that was going to be a reasonable expectation, and here we are. But now with oil down, 7%, courtesy of some just poor timing on OPEC Plus's part, or at least the voluntary members, demand worries as well. So I think as an investor, be wary of overall exposure. But there are opportunities now. Maybe there will be better opportunities over the next couple of days as the market absorbs this news. But you just have to dig. So there's opportunities in oil. There's certainly opportunities in natural gas. And again, for me, for that marginal dollar, we're probably going to be buying natural gas stocks.
And so the yield, the dividend yield on CNQ, about 5.5%, not too shabby. And
very juicy.
What did you say the cash flow yield was roughly?
Free cash flow would be about 10.5 to 11%. It's down 5 now, probably down. Yeah, that's down 5%. So I'd say 10.5 to 11% free cash flow yield. So the key message is these companies have spent the past several years both reducing debt, lowering their cost structure, 66, 67 with a 70-cent loonie and tight differentials. These companies are still doing very, very well. And so, yes, the stocks are challenged today, but the business models really are not under threat from a short-term drop in the oil price. We still think $70 is a reasonable level. We think $4 natural gas, 4 to 5 next year, with that Canadian discount narrowing from roughly $2 now to about $1.10, $1.20 next year. So these companies, you can buy some yielding 7 to 7.5% dividend yields with decades worth of stay flat inventory. We have one named Nuvista. Over the next 5 years, NVA, we have them buying back half of their stock while growing by 50%, funded out of free cash flow. That's at $4 gas. And we think the marginal cost of supply is closer to 5. And so take advantage of days like today, be aware of overall exposure and how much volatility you can stomach. But we will be hunting for opportunities over the next couple of days.
Eric, always great. Thanks for joining us at short notice this morning. Really appreciate it.